Good morning, everyone. Eric Walters, Managing Partner at Summit Hill Wealth Management. Thank you for joining us today. Today, we're going to talk about our mid-year investment outlook. We're going to give people just a minute or two to join. I know we're starting here at the top of the hour. So just please bear with us. Just going to wait about 30 seconds for people to join. So if you're kind of just coming in, we're just going to wait about 30 or 60 seconds for people to join. Again, Eric Walters at Summit Hill Wealth Management. Thanks for joining us today. We'll give people a minute or two to kind of come in here. Again, hey, good morning, everyone. Eric Walters at Summit Hill Wealth Management. We are just giving people a few minutes to trickle in. We will get started in just a minute. All right, let's get started. Hey, again, if we haven't met, my name's Eric Walters, Managing Partner at Summit Hill Wealth Management. Thank you for joining us today for our mid-year investment and economic outlook. Today, we're going to talk about where the economy is. One question that's on a number of people's minds is the threat of a recession. In that discussion, we'll certainly talk about inflation and the Federal Reserve's response to it and how that could spark or lead to a recession. We'll also talk about how the market's been performing lately and how investors can respond. So if you're interested in any of the slides that I'll share, I'm happy to share them. You can reach out to me. My personal email is ewalters@summithillwealth.com, or you can also email info@summithillwealth.com. So let me just share my screen here. I always want to let people know that happy to answer questions. If you do have a question, there's a Q&A button, kind of on the lower part of your control bar. So feel free to hit Q&A. I'll pause throughout our comments and happy to answer questions. And then, of course, at the end, we'll do Q&A. So, the title of our discussion is Fighting Inflation, What's the Cost? And I think that's one of the key questions that investors have right now is, as inflation has reached 40-year highs, what's the cost? Will it lead to, a one-time recession? Will it lead to kind of a major drawdown? So let's get started. Here's exactly what we'll talk about again: the economy, the Fed's battle against inflation, the market, historical perspective, and positioning portfolios right now. If you're not familiar with our firm, we are a boutique wealth management firm that helps successful families manage their finances. Really what we do is we help people protect and grow their wealth. We do that through financial planning and portfolio management. If you're looking for a second opinion about your investments or about your financial plan, we'd be happy to talk to you about that. First thing is, let's talk about where the U.S. economy is right now. For clients, they've seen this graphic for a while, and it certainly seems, based on the data that we're seeing, that we're in this late stage of the economic cycle. This graphic just kind of shows the rate of growth here as, kind of a little mountain. And early on in an expansion, growth is accelerating. Eventually, it kind of peaks and growth starts to slow down, even though, GDP and other measurements of economic growth may be positive, it's slowing down. And that's what we see kind of on the backside here until growth goes negative in a recession. This is kind of the normal economic cycle. Historically, it could go you could kind of go around this maybe as short as 4 years, and then we could see it as long as maybe 12 years historically. So there's no kind of a set number on how long it takes to go through this whole cycle or how long you kind of spend at each of these kind of waypoints. But I think we are definitely in the late stage. Growth does seem to be moderating. A number of indicators, whether it's retail sales or industrial production, are showing that kind of economic growth is slowing. Credit is certainly tightening. The Federal Reserve has already increased interest rates. And if you've read the newspapers, earnings are under pressure, particularly banks. People are wondering about how banks are doing because they tend to be a canary in the coal mine for the economy. Is policy contractionary, at least on the monetary side, with the Federal Reserve kind of holding off on purchasing more assets, allowing bonds to mature. That just means that they're not replacing those. And then, of course, raising interest rates. And then inventories are growing. You may know in the last kind of cycle of earnings that major retailers, think Target and Walmart, said that their inventories are, kind of bloated. And so this idea that there isn't as much demand to take down inventories. And then, as I mentioned, retail sales are heading down. So in terms of where we are in the economic cycle, we certainly seem like we're in this late stage. Now, for those of you who have watched the stock market, the stock market usually looks ahead about 6 to 12 months. So what I think the stock market has been doing is looking at this later stage here and kind of saying, hey, we know the next stage that happens, are we headed into a recession? Now, just because the market is down approximately 20% year to date does not mean that we are in recession or that we for sure will have a recession. The joke on Wall Street is that Wall Street, the stock market has predicted 9 of the last 5 recessions is true. Sometimes the market does grow concerned, and it turns out its fears are unfounded. Sometimes the market is accurately seen ahead. So we'll kind of explore where we are in this, but in terms of where the economy is right now, likely in this late stage, and the next normal stage would be a recession. It's possible that we could have kind of what economists would call a soft landing, where it's pretty mild recession. An example of this would be kind of in the early 90s. Wasn't a really terrible, recession. The market certainly pulled back, but pretty quickly, the market was kind of back to even and growing. That's a good example of kind of a soft landing. Of course, a hard landing would be something like the early 80s or 2008, where for different reasons, the economy contracted quite a lot and the market did. Now, when we think about economic growth, I think it's helpful to look at long-term trend line. And this, I think does a good job just kind of trying to use a regression line to kind of figure out what's been the longer-term growth trend in US GDP. Now, really for quite some time, GDP has been slowing down from a historical average rate of kind of 3.5% to 3% down towards 2%. That's historically normal for larger, more developed economies. They tend to focus more on consumption than productivity. It also happens in people's individual lives, right? Early on in their career, people work really, really hard. They save quite a lot. And later in their career, usually they spend more, they may borrow more, less productive. So it's kind of happening at the national level. And you can see that even though there was an enormous drop-off for 2020 and COVID, GDP bounced back quickly. We're seeing a little bit of negative here, but this kind of shows where we are kind of in this topsy-turvy world. There was an expansion in GDP, up to 2008. We were below growth trend for a while, but kind of slowly increasing. But 2% is probably a pretty good projection, and we seem to be kind of reverting back to that. Now, the challenge that the stock market is trying to figure out right now is how will the Federal Reserve handle these 2 different scenarios? And on one side, we have a scenario where if there is high unemployment and low demand, we kind of know what the economic playbook is. The Federal Reserve or central bank usually maintains or lower interest rates. That increases demand, it kind of increases the wealth effect, and that increases spending power, and financial assets go up. This was after 2008. And what was interesting after 2008, despite predictions to the contrary, we did not see large amounts of inflation, and certainly not the hyperinflation that people saw. A lot of gold bugs, in 2008, 2009 said this is basically the end of the world. I can't believe all this money. Well, it didn't happen. And it's a kind of a question of economics why that didn't happen, but it didn't. Now, I think for a lot of different reasons, we're facing the opposite scenario. We have high inflation and low unemployment. And so what the Federal Reserve is following its rule book, its main tool is to increase interest rates. And as I mentioned, they're also engaging in kind of reducing their balance sheet. In 2020 and 2008, they increased their balance sheet they started buying bonds. And then in 2020, they not only bought normal treasury bonds, but they also bought corporate bonds, they bought mortgage bonds, they even bought some junk bonds, which is kind of unprecedented. And what they do is when they buy those assets, they take the assets off the market and they give cash to the holders, which is usually banks and financial institutions. And that, lowers interest rate, it drives up the value of those assets. And it kind of just helps lower interest rates and puts a lot of liquidity in the system. Well, I think because of COVID supply chains, because of difficulty in finding people, because there was an extraordinary amount of money that was spread around the economy, and the war in Ukraine, we now have high inflation. And so the Federal Reserve is increasing interest rates, And that decreases demand, it decreases wealth, it decreases spending power. It usually creates a recession. And then financial assets go down. And commodities usually go up for a period of time. And then if we go into recession, commodity prices go down. The real question I think the market's trying to answer is how high, will inflation go? The second question is how long will it stay sustained, and how high will the Federal Reserve need to raise interest rates in order to get inflation under control? Now, in one scenario, the Federal Reserve kind of raises rates modestly, inflation comes down quickly, maybe we have a mild recession and things are okay. In other scenarios, inflation stays high or even goes higher, and the Federal Reserve just has to keep raising interest rates, and that has more and more negative effect on the economy. So that's what the market's trying to grapple with, and I think that's basically why the market's been flat for about the past month, because they're waiting to see what's going to happen with inflation. So we will continue to watch that as well and talk about some of the kind of scenarios in just a second. When we think about inflation, I think it's helpful to think about the different components of inflation. Usually inflation is just inflation, it just means everything is more expensive. Well, it's a little more nuanced than that. And I think it's helpful to look at this great chart that shows the components. And the first three, energy, new and used vehicles, food at home, are generally considered transitory. And that just means that those prices can move somewhat rapidly. Both the producers of those goods experience price fluctuations, and then the consumers of those goods kind of expect that prices will fluctuate. So think about the cost of energy, of course, oil, but also gasoline, and then food at home. That's a good example. And you can see, really since really October, November, that many of those items have been growing quite a lot. In terms of their space here. And then of course, the overall inflation numbers have been quite a lot. Then, we've got other parts of inflation that are more sticky. And that means that usually those prices are updated infrequently. Think about rent for an apartment, for example. Usually that's a year lease. Other components of things that people purchase are, maybe they're making a commitment to buy something as a business a year from now, or kind of barber rates, or kind of another good example is mechanic rates. If it's up there on the wall, here's our price for a transmission lube change, it's kind of a pain for them to change that, and so they'll kind of stick with $200 or whatever it is. So those examples of kind of sticky prices, and we can see that those prices usually are more more stable, but they have grown as well. And this is one reason why a lot of people, myself included, thinks inflation could come down if we have a recession, but these kind of sticky prices may take a while to come down. And as I said at our webinar at the beginning of the year, if inflation does kind of peak in the summer, is what I was expecting. We'll have to kind of wait and see if it really does. And it comes down, I don't think it's going to go down to 2.5% or 3%. I think it could go down maybe to 5% or 5.5%. And that's a big reason for that is these sticky prices. Just because now you can see those sticky prices are being increased upwards, and it could be a little bit of time before they get moved downwards, if they do at all. I had breakfast this morning with a gentleman who manages hundreds of properties, and he said only 2 times in his 25-year career has he ever seen rents go down. And that was after 2008 and then also in 2018. So that would kind of imply that many of these sticky prices, once they're raised to that level, they may not go down. They may just be flat. And that may be kind of what happens. And so we may be looking for inflation to come down in these transitory, but then these sticky prices might keep inflation kind of a little higher than we would like. I think the real question is if the Federal Reserve says, hey, we're actually okay with 4.5% or 5% inflation, and we're going to hold on interest rates, that's one example of how they may respond. We'll have to see what happens. I mentioned some of the scenarios that we are facing. One is this kind of soft landing. So inflation starts to moderate, kind of on its own, and the Federal Reserve maybe says, hey, we did it. We're geniuses. We raised interest rates at the right level, at the right amount. And look, inflation is kind of going back down, and we're going to pause interest rates, and we're just going to let the economy continue to grow. In general, I think that would be received pretty well by a lot of investors. They would be thrilled that interest rates are going to go up quickly, and I think the stock market and probably the bond market will respond pretty positively. That's still a possibility because people are rational, and people are looking at prices of hotels, travel, gasoline, food, hotels, you name it. And they are doing what rational people do, and they are pulling back or they're buying different things. And so I think after COVID, there was a lot of pent up desire for travel, a lot of, kind of guilt on the part of parents. We want to take our kids to Disneyland. They didn't have a birthday party. And, a lot of people said, hey, I haven't traveled in quite a while. I think a lot of people are kind of getting that out of their system. And now they're probably saying, okay, now we're going to be more moderate. So it is possible that inflation could moderate just from a lack of demand. A second scenario is a recession. The inflation kind of continues to, push the Fed. The Fed says, it's part of our formal mandate to deal with inflation. So we are going to do that. We're going to keep getting tighter and tighter and higher in interest rates. The economy enters a recession, and maybe the stock market continues to go down. Historically, -20 to -30%, kind of recent price performance is really consistent with this scenario. And so the market's already kind of down 20. So this may be what the market's kind of guessing. A more negative scenario is prolonged higher inflation, which, would be inflation kind of 6 to 8% for the next 2 or 3 years, where the Fed just cannot get it to, kind of come down, even though they're keeping rates high. And what would likely happen then is volatility would start to increase because investors are starting to think, is this the new normal? And if it is, then we're going to price stocks and bonds in a very different way. This is no longer something that's, just something we went through. This may be the new normal. And rather than pay 15 times $1 of earnings on the S&P 500, maybe we're only going to pay 12 or 10. And so once you get investors that start to internalize high inflation as kind of the new normal, you could kind of, have, a lot more volatility. And the worst situation would be persistently high inflation with, kind of low growth and kind of multiple recessions. This is kind of stagflation of the 70s. Now, usually, economies don't go into, stagflation on their own. Usually involves some mistakes by policymakers. And I don't just mean the Fed, I also mean politicians. And so this what happened in the 70s. You may remember we went off of the gold standard. It was chaotic. It was the end of the Vietnam War. The Federal Reserve was not doing a good job, kind of tracking inflation. They were kind of saying it'll be okay. And then there was a number of labor policies that were really problematic for labor rates. If that sounds a little familiar, we have some similarities, right? We have the war in Ukraine. We have, a Federal Reserve that historically over the last 10 or 12 years has been really quick to lower rates and be accommodative or dovish rather than, more strict. We also have politicians that are, for quite some time, politicians of both parties are basically kind of ignoring the national debt and spending, at the drop of a hat. And as that debt kind of gets larger and larger, it does put pressure on, kind of the economy in a few ways. One is there's just a lot of debt out there, that's kind of soaking up investment, right? And it's called the crowding out effect. The other is that the US government is spending a huge amount of money on interest rates, interest payments. And if interest rates continue to go up, that puts pressure on their ability to spend money on other things. And that worries investors. So is it possible we could go into this, as a result of just economic issues, not only within the US, but also things like the war in Ukraine and then policy mistakes? Yeah. It is. It's not my base case right now. I think we're probably looking at something like recession, just because it's so common in history for the Federal Reserve to raise rates into a recession. It just seems to be kind of the default setting, just because there's such a lag in data that the Federal Reserve will feel pressure to continue to raise rates, even though the rates that they have already increased are already effective. We just haven't seen the results yet. So my base case is recession, but we'll have to kind of wait and see what happens. One thing that I wanted to point out is that inflation tends to spike right before a recession. And this is, kind of, if you think about it, kind of makes sense that demand in an economy is usually what leads the Federal Reserve to be concerned about inflation, and they lower rates, and then, demand goes down and prices go down. But this is going back to the early 70s, and you can see in early 70s, we had some big inflation spikes and recessions. And it wasn't all high inflation every single year through the 70s, but it did kind of yo-yo back and forth and some really big changes. And eventually in the early 80s, Paul Volcker had to move interest rates. If you remember, had to move interest rates, kind of up in the 12, 14, 15%. Mortgage rates were comparable to finally beat inflation. And then we had this extraordinarily low inflation for quite some time. And now we spiked back. But My question is, if a recession will kind of drop down inflation as it did before, and could we kind of have a situation where we drop down, maybe in the fives or sixes and it stays there and does not spike back up? Hopefully, but again, it kind of depends on policies. But a recession may kind of cure this, at least in the near term. But I still think that the next 10 years could be very, very different than the last 10. And the last 10 were extraordinarily low inflation with excellent performance in stocks and bonds and real estate. And the next 10 years, I think we will see higher inflation. Again, I think we could be somewhere kind of maybe in this 5% range. And I think more volatility in stocks, bonds, real estate. So we'll talk about what that means for a portfolio, but I think a recession could help inflation. But again, I don't think we're going back down to 2 or 3%. Here's just another kind of look at components of inflation, and this is commodity prices. So the blue here is lumber, and you can see lumber prices are kind of correcting down. And then you've got copper prices, which are correcting down. And then, of course, oil prices are correcting down. So these are, important, kind of inputs to inflation. And it's normal that we have a kind of a commodity spike, usually towards the end of an economic period. And this is when, people just can't buy enough houses. They can't build enough houses. People will travel no matter what. We've certainly seen that in late 2020, 2021 and into 2022, where people were just spending no matter what. It didn't matter how much the house cost. It didn't matter, how much crypto was. It's just, I got to have it. And then you get a correction, and we're starting to see that already. So just another way to look at kind of inflation before a recession. This is just another way to look at what the inflation data is. And I wanted, everyone to see, I know I showed before, kind of sticky inflation, but here's sticky inflation and how, it's fairly moderate, but this move in sticky inflation up here mirrors, of course, broad inflation. But this is what I think has a lot of policymakers and bankers concerned. Because as I mentioned, sticky inflation usually takes a while to come back down. You can see sticky inflation was higher in the 90s. And look at how long it took to get back down to 2. That was about 10 years, right? So again, just another kind of look at inflation. But again, another reason why I don't think we'll necessarily get back down to 2 or 3. I think we might be at inflation of 4.5 to 5.5%. We've talked before about the yield curve as a recession indicator. And this just means the yield on the 10-year treasury minus the yield on the 2-year treasury. And if the yield on the 10-year is higher than the 2-year, we have what's called a steep yield curve. And that's usually very common coming out of a recession, because that means that investors are comfortable lending money, longer term. And so a steep yield curve usually means the economy is on a pretty good path. And then as the yield curve starts to flatten and then even invert, and just what that means is that the 2-year yield is higher than the 10, that just means that investors are not as comfortable. And what's happened is this inverted briefly early in the year. Now it's fully inverted. And you can see with these gray areas of the recession, this inversion of the yield curve has come before every, kind of major recession. Now, the caveat on this is that it's usually anywhere between 6 and 18 months before a recession. And at that point, equities have often already priced in a recession. But nonetheless, the fact that it's inverted and it is staying inverted is a signal to me that we are likely going to go into some sort of recession, and to continue to maintain some defensiveness in the portfolio. I'll talk about rebalancing. I'll talk about kind of putting cash to work. I think there is an argument to be made to do that. But nonetheless, an inverted yield curve is something that I think investors should pay attention to. It's not always really valuable in terms of timing, but it is, I think, a good indicator, at least of how the bond market is feeling about the recession likelihood. We had a question before it started about how do we know if this is, kind of more moderate recession versus, more serious recession or even like a depression. And so what I did is I looked back at a select number of recessions. This is not all of the recessions. I believe that it's about 17 since World War II. I just didn't have enough space, and some of them are pretty mild. But I wanted to share, some factors that investors can pay attention to kind of understand how we would rate the severity of a recession. And the first thing is just unemployment. That's probably the easiest. The more people that are out of work, the more severe it is, because they're not going to be able to pay their lease or buy food or go on vacation. And so I think in a consumer-led economy, unemployment is probably one of the most important. So certainly pay attention to unemployment. That's the first thing we pay attention to. Then we usually know this afterwards. The amount of the gross domestic product decline and duration is certainly a good indicator of how severe it is. Again, that's kind of looking in the rear view mirror. The stock market return is what a lot of people think about, because if you have a period where you have somewhat mild or even positive stock market performance, then yes, it's an economic contraction, and I'm sorry for the people that are out of work. Some people may think, but my portfolio is okay. But a lot of people will really focus on these numbers like -54 and -52 and say, wow, that's to me the worst recession. And in fact, what many people refer to as the worst recessions or the depressions are closely linked in their mind to how the stock market performs. And so, they're not usually as worried as unemployment unless they themselves, lost a job. They're usually thinking, how long did it go? And then what did the stock market do? That's usually kind of it. But while you're in a recession, how do you kind of know? I would certainly pay attention to peak unemployment numbers. You can see a lot of these peak numbers were kind of in the high single digits. If you get peak unemployment that goes past really kind of 8%, you're in the more serious category historically. The other thing you can think about is watching personal bankruptcies. That and unemployment are, of course, closely tied. So if you see personal bankruptcies are going up, corporate bankruptcies, one of the big ones is bank failures. And now the FDIC publishes this data. It's kind of boring reading. But if a number of banks are going belly up and they're kind of applying FDIC insurance, that's something to pay attention to. If you get sovereign defaults, that's something to pay attention to. And then finally, kind of revolts, rebellions, and unrest. Usually in periods of more serious economic stress, you get internal conflict in countries where the countries kind of become ungovernable because the citizens are angry. They are blaming, the other, whoever that is, right? And they kind of become ungovernable. And we're actually seeing this happen. You can almost kind of count how many, kind of leaders are walking away or getting kicked out. Sri Lanka is, kind of collapsed. Mario Draghi in Italy is facing a no confidence vote. He's trying to, maintain, kind of some semblance of ability to, govern. Boris Johnson in the UK is stepping down. And you could look at each one of those and say, well, it's related to issues within that. But it also kind of shows the level of kind of lack of national unity, right? We're not going to necessarily come together and work this out. We're going to, call for their head. And then even, look at it domestically with the US midterm elections, it's very possible Republicans can maintain control. And then that leads to more gridlock and, kind of lack of progress. And so that's an example of, maybe, kind of a democratic example of kind of ungovernability. But those are the things I would pay attention to. I would first, kind of most importantly, pay attention to peak unemployment. I would look at bank failures, and then I would just look at this kind of unrest, like how many countries are kind of going into this zombie zone of just, you can't even govern them. They can't come together behind a leader to kind of fix this. And that usually entails compromise. And this idea that, we're just not going to compromise. It's certainly prevalent in US politics, but it's also prevalent around the world. And that just shows the amount of, distrust, but also kind of unrest. And that's an indicator of kind of how serious it is. One of the paradoxes of everything we've talked about is that while, kind of the recession watch and some of the other issues are, kind of front and center, consumers are doing great. And you can argue that consumers are kind of some of the strongest they've been in quite a while. The chart on the left here just shows consumer debt payments as a percentage of disposable income. And this is a pretty good indicator of how much debt consumers have relative to their ability to pay. And some people might be surprised to know this actually wasn't as high in 2008, but it was still relatively high historically. But, I think we're doing okay. So from a debt standpoint, we're doing fine. And then from a net worth standpoint, relative to income, kind of consumers have literally never been better. Now, we have to caveat this, that this is, overall, and if you look at the top 10%, it's very different than the bottom 10%. But still, when you look at it overall, this is what a lot of news articles are pointing to, that consumers, in general, anyone who wants a job has a job. And, they generally have, money. They're not paying off too much. They're not taking on too much debt, but they feel glum. And the more news about recession happens, the more people maybe pull back and are a little careful. And that can have a self-reinforcing affect, that if people kind of pull back, then those businesses that might benefit from that extra dinner or that extra pair of shoes kind of feel it. And then they go tell a reporter, yeah, we're not selling as many shoes. And then consumers go, oh, wow, maybe I should stop buying shoes. And then they stop buying pants. And then, there can be some self-reinforcing. And there's been some news articles lately about the possibility that the US could talk itself into recession. And that is true. There is kind of a herd mentality in economics and investing that, for example, if crypto or real estate is just going up, you get people that are like, hey, it's going up, I'm in. And then conversely, if prices are dropping and, news articles are glum, you can get people that are actually wealthy and have money kind of go, we're not going to go on that vacation. So we'll have to wait and see. But the good news is that this is one reason I think we could have a more moderate recession because of these numbers. If you are in a consumer-led economy, even if people are concerned, they're still, going to do okay. So personally, I think, I bet we go into recession, it's a softer landing. That's, kind of my expectation. One kind of interesting, part about consumers and the stock market is how bad consumer sentiment is as a market timing device if you look at how negative people are. And this is one of the probably 5 or 6 kind of indicators of capitulation that kind of market watchers look for, is really, really, really low consumer sentiment. And so this chart just shows kind of a consumer sentiment, and this is through a survey. They just kind of survey consumers in a rigorous way. How do you feel about your job? How do you feel about spending? How do you feel about the economy, and so forth? And this is almost a really good kind of contrary indicator. I don't think you could really use it to time markets except on the lows. And so when you kind of get below like 65 on this index, historically, the performance after that has actually been pretty good. And you can just look back and see kind of May 2008, kind of great performance. 1990, this corresponds often with a lot of, kind of recession feeling. 2008, certainly 2011, and then now. And so we're kind of low as we've been since, the 80s in consumer sentiment. And, this is probably one of the reasons why I would tell clients, hey, not a bad time to think about starting to rebalance and slowly put cash to work because consumer sentiment is so low right now. And historically, that's actually not a bad time to start thinking about, kind of deals in the stock market. When we think about the stock market, you can see how the market's performing. I mentioned this in prior webinars this year, but for all the gold bugs in your life, all the people just love gold. They just, they love holding it gold. There's nothing wrong with that. I don't have a problem if people hold some gold. I just wouldn't hold a lot of it because here we are in the worst inflation that we've experienced in 40 years. And according to the gold bugs, gold should be exploding, right? It should have doubled in value by now. It should have just, it should be the new currency. We should be walking around and paying for lattes with gold bars. Well, unfortunately, that's not what's happened. And gold is, declined. And a lot of people say, well, we have to wait for hyperinflation. Well, to me, it just seems like gold is an emotional asset and kind of the air is coming out of the tires, I think, on the story with gold and inflation. And I think if there was ever a time that the gold bugs should be celebrating, I mean, this number for gold should be like up 500%, but it's not. When we look at bonds are a loan to someone in the future, and they'll pay you interest along the way, and then you get your principal in the future. With high inflation, your interest payments along the way and your future return of principal aren't worth as much. And so bonds are down year to date about 10%. And that's unusual. Historically, if the stock market's down, the bond market's been up. But with high inflation, bonds have suffered. You can see kind of the results here for, US large cap companies down about 20%, international stocks right there, real estate, and then small cap is doing slightly worse. So we're down kind of in that area where the stock market is really thinking kind of recession is kind of my take on this, and or inflation stays high. One of the both. And then, cryptocurrency, holy moly. This is an index here of the top 10 largest crypto assets. And that's, 70% of that's Bitcoin and then other small ones, down about 70%. The narrative that crypto was going to be a great hedge against inflation. Nope. The narrative that crypto was going to protect against stock market declines. Nope. So I think this shows that crypto is truly a speculative asset. And we don't know if this is like Web 3.0, where the technology is going to come around and we're just going through like a tech crash in 2000, or if this is one of those things that the hype just was ridiculous. There was a huge amount of money, and yes, there's some useful technology, but it's never, ever, ever going to get near where it was. Hard to say, but incredibly speculative. And I think, this is why I had a number of conversations with clients about it. And I said, hey, for those that were really adventuresome, I was willing to put maybe maximum of 1% of a portfolio value into crypto. And even then, right now, those positions are down, approximately 70%, right? And it's like, well, good thing we treated it like the incredibly speculative asset that it is. Who knows what's going to happen in the future, but just not the inflation or market hedge that people thought it was going to be. One of the other things that if you are a fan of economics, you may know, if you're like me, you'd find this really interesting, is that the dollar is incredibly strong. Since the end of last year, the dollar has appreciated against all major, and even minor currencies. This is just a graphic from the New York Times that just shows that the dollar is kind of steady. All these other currencies are down quite a lot. I mean, look at where it is against the euro, the UK and the yen. This is just because people are hoarding US assets. The US is still viewed as the safe haven. And if you remember your economics 101, if people in one country are buying a lot of assets in another country, that just creates demand for that country's currency. And that's exactly what's happening. Treasury bills, treasury bonds, US assets, US dividend paying companies. So that's, it's good and bad. It hurts exports. And there are a large number of S&P 500 companies that are global. They're based in the US. Their operations are in dollars mostly, and it hurts them. And so we've heard in Q2 earnings reports of some companies saying, the strong dollar is really hurting us. And that's part of the hurt that's happening with some earnings. But of course, it helps imports. So foreign companies that are selling into the US are seeing strong demand. And of course, it really helps US consumers that are traveling, and so if you've seen the Wall Street Journal and other articles saying the US, people are saying, I'm going to Italy, I'm going to France, I'm living it up. And they're experiencing higher transport costs to get there and hotels. But they are kind of enjoying that. So kind of interesting to see. In general, that's one reason why a lot of people really want a strong dollar. They feel it's very important from almost like a philosophical standpoint. We should have a strong dollar. It's very important. And a lot of economists and politicians that listen to economists kind of say, well, just remember our largest S&P 500 companies are hurt by this. And if anything, kind of a weak dollar kind of helps them. And so you get this kind of fight between economists and politicians who listen to them. And then just kind of this gut feeling that people have, like, I want a strong dollar. It sounds great, strong dollar. But you have to grapple with the pros and cons of it. So I won't get into that, but that's kind of the reason why often if you hear about a strong dollar or a weak dollar, sometimes the news articles kind of seem muddled, and some people just think, well, duh, we should just have a strong dollar. What's the problem? And that's why there's no kind of clear, easy way to kind of square that. So let's talk about kind of historical perspective on how markets have performed in the past. And when we talk about the stock market being down 20%, usually people I work with, clients, are usually have one of two reactions. One is, that's fine, I'm a long-term investor, I'm okay, thanks for the update. And then others say, this is horrible. I cannot believe that my portfolio is down 20% or whatever. It just feels horrible. Am I going to be okay to retire? Both responses are logical. It's no fun to see portfolio values down. But when we think about how the market has performed in the past, 75% of the time the market's been up, and the negative 25% is the minority. And actually, there's very, very few times where you're actually down kind of 20% or more. And so this is on the left-hand side here. If you look, each one of these little blocks is a year. And that year, they're kind of just, it's a histogram on what the return was. And you can see there's actually very, very few times when you're down negative 20 or more in a given year. Now, so far year to date, we have been. A parallel to this is actually in 2012, when there was a fear that the Eurozone might break up. We started the year fine economically. And then as the fears built that the Eurozone might break up, by like August of that year, the stock market was down about 22%. That resolved quickly. And then by the end of the year, by the end of 2012, we had a very minor loss. And so we kind of went, round trip within the year. And that is often what happens. So within the year, you can get these drawdowns and it's like, oh my gosh, everything's terrible. But then you can, kind of pull out of it by year end. And that's why it's actually more rare to end in -20, -30. So some clients have asked me, Eric, you kind of seem, kind of calm about this. One is I know it's fairly rare to have these down years. And the large majority of time, if you look at kind of these size of these stacks, it's really, usually it's kind of 10% and up is, more normal for the stock market. And then often I know we respond and rebound pretty quickly. And then hopefully if I've done my job well, I'm not taking too much risk in client portfolios. We're allocating the right amount to assets that are volatile. But so if you were a betting person and you were already down 20%, the strong likelihood is that you're going to do pretty well a year from now, pretty well, 3 to 5 years from now. It's unlikely that you're going to get to this, -40, -60%. It's always possible. We've had that happen, but less likely. So that's why I always like to look at data. It helps us kind of understand where do we go from here? Kind of how do we put this into context? This is a great graphic. I love this. I shared this at our last webinar. This is just, put $1 in the global stock market. This isn't even US S&P 500. The global stock market, think about all the horrible things that have happened. Wars, recessions, rebellions, revolts, the death of equities, the Y2K crash, 2008, COVID, blah, blah, blah. And that dollar becomes $80. And it doesn't mean that it's, it feels good to go through, a down market, but it does mean that we've always kind of went through a low and reached a new high because companies are designed to figure it out. If they need a new market, if they need to hire different people, that's what companies do. And that's in aggregate what protects investors. Big question I've gotten from a lot of clients is, hey, could we just kind of step out of the stock market and, maybe we just kind of go to cash? And there's nothing wrong with being a little more defensive in a portfolio, but you do have to be careful. If you miss just a few days over a fairly long period of time, it permanently reduces your return. And so this chart to me just is incredible. If you look at 30 years from 1990 to 2020, and you were just investing in the S&P 500 the whole time, start with $1,000, becomes 20,000, you get a great return, 10.2. But if you miss just one day, it shaves off, almost $2,000 off your final return and, starts to affect it. If you just miss 5 of the best days, your return is considerably lower. So this is why, I am hesitant to try to go to all cash, right? It's just because usually the worst days follow, or the best days follow the worst days. If you're down kind of 4 or 5% in one day, history would say often within a week or two, you might get kind of a plus 4 or 5%. We've certainly seen that this year. So stick to your path, be careful of kind of catastrophizing because, you could give up a $20,000 type return for like a $7,000 return. And that permanently hurts. To my point, a lot of people say, hey, if we're down, really seriously, it's going to take a long time to come back. Maybe 10 years. It could take a long time. And thankfully, not really the case. So if we look at a portfolio of 60% stocks and 40% bonds, here's where that same portfolio was kind of 1 and 3, 5 years. And in general, doing pretty well. Now, not always, right? You get some periods like, 2020 where it was, it hurt portfolios values for a while. So you can mark it and say, well, yeah, not always the case. But in general, a well-diversified portfolio can weather these storms within, 12 months, and so forth. So again, I love the data because it just shows us kind of the context and information. So our investment philosophy is to focus on what we can control. And, that is creating an investment plan, understanding your risk, structuring a portfolio, diversify globally, manage expenses and turnover, and then stay disciplined. It doesn't mean you don't make any changes, but be careful of this idea that we're going to swing like all the way to cash, and we swing all the way back to equities or something like that. That is a really difficult way to live. And as we saw in the prior slide, you're really risking long-term returns. So let's get to kind of the so what. What should we do as investors? So I always recommend we look at the financial plan for you and your family, because that's the reason why we're investing in most cases, so that you and your family can enjoy your wealth for whatever is important to you. And that's where, the stock market being up 20% or down 20% doesn't have a context or doesn't have a meaning until we put its meaning in your life. So for example, if you have a kid in college, that may be why you're investing, or if you have a child you want to go to college, or if you're preparing for retirement, or you're supporting your loved ones. These are all good reasons to go to the stock market and partner with it to grow. And then when I say stock market, it means bond market and real estate market. So first, look at your financial plan. Second, make sure your risk tolerance and goals are in sync. I'll talk about that. And then I'll talk about some ways to assess the portfolio and some changes that we can make. And finally, you should go to Europe. If you have a chance, you should definitely go to Europe. The dollar and the euro are almost at parity. That's about a 15 or 20% discount on a lot of things in Europe. So if you are an oenophile and you love wine, go to France. If you're, looking to get some clothes in Italy, you should do it. So I talked about a financial plan. This is a chart of what we use with clients where we want to chart the value of their assets over time. We want to think about, good things happening and challenges. And we want to see, what's the probability of success? And this is what I want to see, a high probability of success. And what I do with clients in down markets is we go back to this plan and we say, what does a lower portfolio value mean? And in most cases, it doesn't affect their long-term plan. And so that's the best thing that could happen, I think, for an investor is to say, I'm okay. I'm all right. We already know that inflation could be high, taxes could go up, returns could be poor, and I'm still okay. And that's what, if you look at this graphic on the lower part of this spread, that's usually what I want to look at. What if things go worse than expected? Not median and not best case, but what if things are worse? Are we still okay? And that's the so what, right? You can go to Europe, you can enjoy a Viking River cruise, you can send your kid to college. That's what matters. So look at the financial plan. If you don't have one, let us know. We'd be happy to talk to you about getting one. Finally, and make sure, or not finally, but to continue, make sure that, when you think about buckets of money that you're investing appropriately. If you are thinking about, your portfolio and your assets you're going to live off of, right? Maybe you've retired or you sold a business. Those assets that you're going to use in the next year or two should be in a very conservative investments, including cash, and you should expect low returns from them. And the problem is sometimes people take assets that they want to live off of and they say, hey, maybe I should put this into crypto, or maybe I should buy Johnson & Johnson stock. I said, no, you should not do that. So assets we're going to live off of, if you're at that point in life, be moderate. When we're thinking about 2 to 8 years, this is where it's good to get income investments and assets that will grow modestly, but aren't going to be as risky. And then assets that you don't think you're going to need for 8 to 10 years, then yes, let's be aggressive. We can invest in stocks and private equity and hedge because you can handle those fluctuations. It's 8 to 10 years before you need that money. So this is how you build a portfolio. You figure out how much money do you need for it, how much, emotional risk can you handle? And then let's assign it. So again, if you are feeling a lot of stress in this market downturn with equities down 20%, bonds down 10, then maybe this mix isn't exactly right. And, if you're a client, we can talk about making changes. If you're just like, hey, I'm in cash and maybe I can take more risk, or I'm in stocks and I feel terrible. This is kind of the path for fixing that. And when it comes to portfolios, here's kind of what we're working with clients right now. Again, we don't know if we're going to go into recession. We don't know if the stock market will continue to fall, but we want to maintain discipline and we want to keep investing in risky assets, but we want to kind of identify opportunities, and then we can make some tweaks to the rest of our portfolio. So we want to stay disciplined, but it doesn't mean you don't do anything. And so one thing we've been doing is favoring high quality, less expensive, called value, and dividend paying stocks. Now, often less expensive and dividend paying stocks are kind of the same. These have been out of favor for probably the last 12 years. We've been talking to clients about allocating money to them. Suddenly they're very, very popular, but we're maintaining our discipline on the more affordable, kind of quality companies. They're doing pretty well. And we always think they probably will do, because in general, over long periods of time, high quality companies, and if they pay a dividend, that's great, usually do well in good markets and down. So in general, we kind of like that. And profit is usually a pretty good indicator of how, how quality a company is. It's not a bad time to rebalance. And so, we can add to our positions. If you're kind of scared and like, hey, this is really freaking me out, we do not need to rebalance. But if you're feeling, hey, we can be a little more aggressive, perfectly fine, I think, to rebalance now and into the fall. And then remember, stocks are a great inflation hedge. So if you are worried about inflation, many of the things that create inflation are created by companies. And here's what I mean. If you think about like the Pampers Index, right? This is an unofficial inflation index, or just the cost of diapers. Well, Pampers are created by Procter & Gamble. And so the fact that they are raising prices, and that's showing up in a news item, means they are raising prices and defending their own profits. Now, it doesn't mean the stock price doesn't go down, but if you think about it, like, do you want to buy Pampers or do you want to own the company that makes Pampers and raises the prices? Oh, well, I like to own, the company that raises prices. And so it's the same thing, and whether it's shoes, restaurant groups, producers of copper, these companies have the ability to raise prices to kind of keep up with inflation. And if inflation comes down, they'll be forced to lower prices. But again, that is counterintuitive for a lot of people. If stocks are down, like, why would I buy them and own them as an inflation hedge? Because the stock prices are transitory, right? They go up and down, but good profit oriented businesses can make it through. And when it comes to bonds, we're in a unique position with bonds because bonds have gone down. And so one strategy that we're using with many clients who are just not comfortable with as much fluctuation is we're building bond ladders. And I'll give an example, but we basically create our own bond fund with maturities every year. And when a bond matures, people can spend it or they can just invest in a bond ladder. So bond ladders are more conservative, and it's one way to do it. We do try to find managers with a track record of handling volatility interest rates on the bond side. They do pretty well. And then I'm reducing allocations to international bonds because of the currency risk. And then we've talked about diversifiers, real estate, managed futures, commodities, private equity, hedge. These are institutional assets that are doing well. Managed futures, commodities, private equity, and hedge are by and large all positive year to date. And we've been moving client assets into those to kind of defend against the kind of down market in stocks and bonds. And it's worked well. It's not a magic pill. You don't put 100% of a portfolio into this, but they do pretty well. So I will wrap up by just kind of showing people what a bond ladder is. A bond ladder is, rather than invest in bond funds, we basically take, in this case, $1 million, and we spread out the amount that we invest, and which will therefore mature over a period of time. And if you kind of cut this right in half, that's your average maturity. So here, the average maturity is about 4 years. And you can see right now, at current interest rates, the $1 million portfolio would yield about $54,000 per year. That's taxable. If you invest in municipal bonds, it's lower, but you're free from tax. And then each year, in 2023, about $100,000 in this example will mature. And if you're retired, we would move that into your bank account, maybe some, all of it, maybe all of it. That becomes your kind of paycheck. If you don't need it, we take the 100,000 and then we buy 100,000 that matures in 2031. Now, what's nice about this is that it's a much, a much more conservative way to invest in bonds. They don't go up as much when interest rates go down, but they also don't decline as much. And because we don't know where inflation is headed, this may be a solution for you. Again, if you're a client of BNY Mellon, we have already shortened your average, maturity. And then for many clients, we're talking about bond ladders. If you're not a client of our firm, happy to talk to you about pros and cons of how to invest in bonds. It's, sometimes bond funds are great, sometimes bond ladders, but this is a strategy that we are working on. And these rates, came out, just 2 days ago. So these are kind of current rates. So I'm going to just pause. I will kind of stop sharing my screen here. And what I'm going to do is just answer questions. So if you have a question about the stock market, the economy, inflation, happy to do it. We've got a question. So it says, you show real estate is down. Just curious where. It seems everywhere is sky high. That's a great point. Particularly in Denver, you still see real estate prices that are kind of there. Real estate. So when we talk about real estate as an asset class, in general, we talk about real estate investment trust. And so from a stock market side, you basically are looking at prices of medical buildings, office buildings, and so forth. And in some markets, you're getting prices that are kind of flat to slightly down. And then in the public markets, investors have just pulled money out. So prices are down. And then when you look at the Case-Shiller data, in Canada, for example, the year-over-year price numbers are down about 8%. In New Zealand, they're down about 5%. In the US, they're up about 20%. So, in the US, we haven't seen real estate prices come down over a year-over-year basis. They are kind of coming down over like a month-to-month basis. And what we're seeing is more days on market and less houses going for over asking. So that's kind of what's happening in the U.S. market. But you are getting a lot of kind of anecdotal data that sellers are cutting their prices. They're accepting lower bids. The national realtor firm Redfin put out some data about 3 or 4 weeks ago showing that a number of sellers in the U.S. are cutting their prices and accepting a lower price. So is that, does it really show that real estate's in a rout? No way. Over year basis, you're still up quite a lot, but it does show that higher mortgage rates are having an effect. So we'll have to wait and see. And this is what, the Federal Reserve is really preoccupied with real estate. They would love for rent and equivalent rent to kind of come down to help inflation numbers, but they may need to spark a recession to get there. So we'll have to see. But in general, if you think about higher interest rates are going to lead to higher mortgage rates, that'll just reduce affordability. So a lot of people will go to market and kind of say, this is what we can afford. And sellers who maybe thought their house was worth $600,000 before are like, well, I bought it for $400,000, so I'll take, $525,000. They'll still take a profit, right? It's just that number wasn't quite as high. So thank you. All right, we got another question. Impact of housing shortage versus housing affordable, lack thereof. Oh, okay, yeah. So the question is there a housing shortage versus how affordable is housing? So this is a great point from Brian. So there does seem to be a housing shortage in the United States. After 2008, home builders, whether they're individual or companies that build homes, just kind of went into deep freeze. And slowly, starting about 2012, they started to build more. And then, of course, in 2021 and 2022, they're trying to build houses as quick as possible, but we're still short. And so there's a housing shortage, and then there's not much affordability. And so when you look at those two together, you might think, well, prices might stay high for a while. And that is true. And so I think because it takes a while to build houses, I think the metric that kind of has to give is the price of a house. And I think you'll see more families just rent. If they're going to move to a new market for a job or something, they might just say, prices are crazy. We're just going to rent. So I think you'll see demand for that. And the question here is asking, is there an investment opportunity related to this? I think so. And there's been a lot of large investment firms that have been buying up residential investment homes by the hundreds of thousands. So BlackRock is doing this, private equity, hedge funds are doing this. And a lot of people blame these funds for driving up prices. But a lot of these investment funds basically think, hey, with high prices, there's just going to be a huge demand for just rental homes. And so I think, that investment opportunity was probably 4 or 5 years ago, if you were going to start building a position. But homes, I think, are pretty expensive now. If you're put on your real estate investor hat, they're somewhat expensive. And I think if you wanted to invest right now, I think it depends on kind of your mortgage financing. If you're okay doing an interest only or adjustable rate mortgage, you probably can get some positive cash flow out of a property. If you do a straight 15-year, I don't know. My impression is it'd be hard to really get positive cash flow on a rental property right now. And so I think you have to think, if you're a real estate investor, you'll play this game carefully. And then, if you buy property right now and rent it out, you could refinance later if rates go down. And if rates go up, you got a decent opportunity. So yes, I think there's some opportunity there, but I think you'd have to pick your geographic location. Denver is somewhat expensive. Aurora is more affordable. So I would think about maybe outlying areas. You can think about Colorado Springs is still, I think, pretty affordable. Aurora is better. But downtown Denver and places like Cherry Creek and stuff like that, I think it'd be hard to make a lot of money on it. Great questions. Thank you. So happy to answer any other questions. We have a few more minutes. If anyone, again, is thinking about economy, stock market, investment, happy to address it. I'm not seeing any off the top of my head. So thank you very much for your time. Thank you for, kind of joining us to kind of look at this, these questions. But I think my takeaway would be, we may be entering a recession, but I think the question of how the economy is doing and whether we're in a recession is probably less important for most investors as compared to their own financial plan, their investment discipline, and their ability to kind of get through. And if they're interested in rebalancing or putting cash to work, that's a more aggressive stance. But just kind of maintaining discipline going through this is probably, I think, the best way to do it. Again, if you're a client of BNY Mellon, or excuse me, of Summit Hill Wealth Management, thank you for your business. If you're not, we'd be happy to work with you. In the chat function, we will put our email. It's just info@summithillwealth.com. Feel free to reach out. We'll give you a second opinion and take a look at your portfolio. We will take a look at your kind of financial plan or lack thereof, and happy to answer questions. So again, I'll wait another minute to see if there's any questions. Otherwise, we'll wrap up. All right, again, we're not seeing any questions. Thank you again for your time. Our email will show up there. And again, thank you very much and have a great day.